Javon Pera with PeraLoans.com, and today we're going to be talking about terms and concepts for shopping for a loan. So it can be really confusing when you're getting data to be able to decide, how am I going to shop for a loan? And a lender could say one thing and you think it means that, but it actually means something different. So here's some key terms for you to know so you can be on the know when lenders are trying to trick you. No, they're not trying to, but it seems like that sometimes. So the first one is APR. So what's the difference between the rate and the APR? Well, the APR is really the rate for your loan, the interest rate, plus all of the costs of the loan, and it's amortized over the duration of the loan. So the APR is always going to be higher than the interest rate that you're going to get for your loan, or the note rate. So just know that the APR, it's just so you can, it's supposed to be able for you to be able to shop considering all the costs. So it's going to be a little bit higher. So then there's the note rate or the interest rate. It's the same thing. The interest rate is the rate that you're going to pay, the interest rate on the loan that you're getting to buy the house. Now that is the note rate, same thing, and that's the thing that's easier to shop with, but it doesn't include all of the costs associated with it, which could be points, which could be all the cost of the loan, the title, the escrow, the appraisal, the lender costs, all that stuff. It's just the interest on the loan. The next one is rebate versus points. So whenever you have an interest that you say, I want that rate, lock that rate for me, you tell your lender. Well, any given rate, depending on the market condition, if you lock it, let's say that the rate that you're offered is a 3.5%. If you raise the rate to 3.75%, that's 1/4% higher, well, your lender will get a rebate most likely from the bank. They get paid to give you a higher rate. Most lenders, myself included, would give you that rebate to pay down your costs. But the other side is true as well. 3.5%, well, I want a 3.25, that's lower. In that case, there would be a cost to get that rate because it's lower than what the market is giving you. So that quarter is actually, it's called a point, or 1/4 of a point. A point is 1%. So rebate, your higher rate, points cost is getting the lower rate. The next thing to consider is closing costs. What are closing costs? Because there's prepaids, there's third parties, there's lender costs, there's the appraisal. Well, closing costs altogether is everything that's out of pocket for you to close that loan and get your house. So the lender costs, well, that's processing and underwriting and administrative and doc prep. I mean, lenders, they charge all kinds of stuff in there. Third parties, the third party fees, it's the people and the fees that aren't the lender. So the appraiser isn't the lender, title is not the lender, escrow isn't the lender, and there's also state and county fees and recording fees, all these things that aren't the lender that you're going to have to pay for still to get this thing to close and to get into your house. So consider those. Now prepaids are things that you would have to pay anyway if you owned a house. So if you own a house, you have to pay property taxes. If you own a house, you have to pay hazard insurance if your house burns down. Those kind of things. And the prepaid, sometimes you got to pay in advance a little bit to be on schedule. So those are all the terms. Hopefully this is helpful for you to be in the know so you can be able to shop intelligently. Javon Pera, PeraLoans.com.